어떤 의미도 내게 미안하지만 I'm not sorry 오늘부터 나 Bitch 나는 solo Bitch 나는 solo
Assalamualaikum to Madam Zuraida. Today, me and my friends are going to present our first group project. My name is Hafshah and I'm going to present question 1. For question A, the question asks about the appropriate accounting method for Mercury Berhad to record the investment in Mars and Venus Berhad. According to FAR610, the relationship between investor and investee can be classified as parents and subsidiary if entity fully own or partially control over another entity. Ownership is determined by the percentage of share held by parent company in which must be at least 51%. Alright, since Mercury Berhad own 60% and 70% of ordinary share in Venus Berhad and Mars Berhad, they are considered as subsidiary. Therefore, the investment in subsidiary is accounted using the consolidation method. This method record the investment in subsidiary in the parents as an asset in the parent's company balances, while recording an equal transactions in the equity side of the subsidiary balance sheets. The subsidiary's assets, liabilities, and all profit and losses items will be recorded in the consolidated financial statements of parent company, which is Mercury Berhad.
Assalamualaikum. My name is farhana. For question 1B, it stated that how to compute the goodwill or bargain purchase of acquisitions of Venus Berhad and Mars Berhad. For consideration transfer of Venus, it is Rm 3.6 million. Mercury acquired 1.2 million out of 2 million ordinary share capitals in Venus. Since it is stated in the question that consideration transfer is Rm3 per share, hence the consideration transfer for the whole acquired share is 1.2 million multiplied by Rm3. It is derived at 3.6 million. For NCI, it is arrived from the fair value of net asset in part B multiplied by the 40% of NCI. On the fair value of the net asset, the amount of OSC is after adding the bonus issue declared by Venus. The OSC will increase by 400,000 as well as general reserve will decrease by 400,000. For the ARR, the amount arrived from the date of acquisitions, which is the fair value of PPE, is excess of 1.2 million. So, the goodwill of Venus is Rm 480,000, but the additional information number 11 stated that there is impairment of goodwill. Thus, the amount of goodwill must be deducted with the 5% impairment, and the total goodwill is Rm 456,000 will be recorded in SOFP. For Mars Berhad, the consideration transfer is 2.52 million is arrived from the 2.1 million multiplied by Rm 1 ringgit and 20 cents. Retained profit of Mars is derived from 1 million from the SOCHE plus dividend payable and multiplied by 6/12. Mars has not yet recorded the customer list at the date of acquisitions, hence this company need to record it at the fair value of net asset. The bargain purchase of this company is 1,065 million.
Alright, next I'm going to present about question 1C, where the question asks for NCI and group retained profit as at year end 31st December 2017. I'm going to start off with subsidiary of Venus Berhad, where the retained profit as at year end is Rm 6,300,000. Next, there is a pre-acquisitions that need to be deducted from the retained profit at Rm 1,500,000. Next, there is under provisions of depreciation ARR at Rm 300,000. Next, there is an under provisions of depreciation ARR at Rm 300,000. This amount derived from the acquisition date, where there is an excess of fair value at plant and equipment Rm 1.2 million with a useful life of 4 years. Next, there is an impairment of trademark at RM 100,000 that also need to be deducted from the retained profit. Next, there is an interest on debenture. However, this interest on debenture need to be added out back in the retained profit of Venus because this should not be paid by Venus Berhad. However, need to be incurred in the Mercury Berhad. To sum up, the post-acquisition profit is RM 4,300,000. This 4 million need to be portioned into parent and NCI at 60% and 40%. Retained profit for another subsidiary which is Mars Berhad. Okay, for the retained profit as at year end is RM 1 million. As you can see, we need to deduct pre-acquisition profits from this retained profit which is RM 550,000. Next to be deducted from this retained profit is under provisions of amortizations. This amortization derived on the acquisition date of Mars where a customer lease have an assess fair value of 1 million with a useful life of 5 years. There is also unrealized profits of inventory incurred by Mars at RM 200,000. Next, there is an ordinary dividend payable at 150,000 is given in additional information 8 from the questions. There is also preference dividend payable at RM 100,000 that also be deducted from here and given from Soche of Mars Berhad from the question. So, to sum up, the post-acquisition profit of Mars as at the end of the year is a negative 200,000. We need to portion this into parent and SI which is 70 and 30%. For the retained profit of parent which is Mercury Berhad, the retained profit as at year end is 60,800,000. As you can see, we need to deduct unrealized profits of equipment at 500,000. This is given in additional information number 4. Besides, there is also over provisions of depreciations from additional information number 4. But we need to add up back these depreciations because as at the year of disposal, Mercury should not depreciate the asset. Next, there is an ordinary dividend payables of Mercury given in the statement RM 200,000 that need to be deducted. The preference share dividend receivable is from Mars Berhad where 40,000 we add in this retained profit. There is also ordinary dividend receivable from Mars Berhad at 105,000. Also ordinary dividend receivable from Venus at 120,000. Also impairment on goodwill at 24,000 which can be seen.
Question 1D asks us to prepare the consolidated statement of profit or loss. For sale, we need to add all 3 companies' sale except for Mars Berhad. We need to multiply by 6/12 since Mars Berhad acquired by Mercury at 1 July 2017. This adjustment will be the same for all amount in Mars Berhad of CSOPL. After that, as mentioned in additional information 2 and 3, there is an intra-company sale of inventory happened. The amount of 15 million and 30 million must be deducted from the total sale. For cost of sale, after adding all 3 company amount, we must deduct the 15 million and 30 million from the total cost of sale. Then, we must add the unrealized profit from sale of inventory of 200,000. In operating expenses, after adding all 3 company amount, we must plus with the under provisions of depreciations of RM 300,000, under provisions of amortizations of customer lease 200,000 plus with the 100,000 of over provisions of depreciations. Next, the impairment goodwill is derived from the impairment goodwill of 5%. Then, the impairment trademark is the difference between recoverable amount and carrying amount of 2.5 million and 2.4 million respectively. After do all the calculation, we will derive at profit after tax of RM 11.651 million. For profit attributable after tax, first of all, we need to calculate for NCI portions. As you can see, at the calculation here, the end of the calculation is RM 1.88 million for Venus and 60,000 for Mars. This amount will be transferred to CSOPL as profit attributable after tax of NCI. For parent, we will record the difference between profit after tax and profit attributable after tax of NCI, which is 9.711 million. For question 1E, we have to prepare for consolidated statement of changes in equity. First of all, we need to portion the retained profit of the year of Venus into group and NCI portions. We also need to record the NCI in Venus of 2.08 million. Hence, we will derive at the total amount of group retained profit of 10.95 million, and for NCI is 2.68 million need to transfer to statement of changes in equity. Next, we need to add the acquisitions for the year of NCI column of RM 1.365, which is the acquisition of Mars during the year. Then we need to add the profit for the year from SOPL at column group and NCI and deduct the dividend payable of RM 200,000 from Mercury at group column. For NCI, RM 125,000 is from dividend of NCI, which is ordinary dividend from Mars and Venus. For RM 60,000 is dividend preference share capital from Mars Berhad. As you can see at the diagram, the balance carried down of RM 20.461 and RM 5.8 million. These two amounts must be transferred to CSOFP as group retained profit and NCI.
For question 1F, I'm going to present consolidated statement of financial position for Mercury Berhad. Under property, plant and equipment, we need to add up the three companies' PPE, and there is also over provisions at 100,000 that need to be added up. Next, we need to minus 300,000 of under provisions of depreciations, profits of selling asset at 500,000, and we also need to deduct 2.5 million of trademark inside PPE. Next, there is an intangible asset which is trademark at 2.5 million minus with 100,000 of impairment. There is also customer list at 1 million minus with 200,000 of amortization. Under the current asset, we have an inventory where we also added the three companies' inventory, but we minus 0.2 million of URP in inventory. Next, there is also bill receivable at 25 million that need to be deducted with 15 million of undiscounted bills. Under account receivable, we need to deduct 1 million in transactions between Mercury and Venus Berhad as given in additional information number 5. Under equity and liabilities, we have ordinary share at 10 million plus with 2.1 million of bonus issuance. Under non-current liabilities, there is 3% redeemable preference share at 1.5 million, and there's also 7% of bank loan at 2 million. Under current liabilities, there is account payable at 25 million minus with 50 million of undiscounted payable. Next, there is also ordinary dividend payable, but this amount need to be deducted with 120,000 of in-transactions and 105.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Farahin binti Ahmad. I'm going to present on question 2. For question 2A, the question asks to state on the area covered by the contractual arrangement under specified MFRS 11 joint arrangement. The area covered are as follow. The first area covered are the activity, duration and reporting obligation of the joint arrangement. The second area covered is on the appointment of board of director or equivalent governing body and voting right of the ventures. The third area covered is on the decision-making process such as voting right, matters requiring decision by the parties, and the required level of support for these matters. The fourth area covered is on the capital or other contribution by the parties. Lastly, the area covered is on the manners of sharing among the parties of the joint arrangement asset, liabilities, expenses, profit or loss. For question 2B, the question asks to describe joint control according to MFRS 11 and provide one scenario as an example. According to MFRS 11 joint arrangement, Joint control exists where the parties are contractually agreed to share control and decision about the relevant activities of the joint arrangement, which have the unanimous consent to all the parties of sharing control. The party have to assess the extent to which the party should act together to direct the activities that significantly affect the return of the investment. For example, Ali, Abu and Ahmad are the parties to an arrangement, where Ali having 40% of voting power, while Abu and Ahmad having 30% of voting power. The contractual agreement between these three is at least 80% of voting rights are required to make decisions about the relevant activities of the arrangement. In this scenario, Ali, Abu and Ahmad have joint control, therefore all of them have to agree to the decision. For question 2C, the question asks about the accounting treatment for each type of joint arrangement specifically related to the right to the asset and obligation for the liabilities. According to the standard, there are two types of joint arrangement, which is joint operation and joint venture. As for the right to the asset in joint operation, the parties to arrangement will have to share their interest in asset relating to the arrangement in a specified proportion. While for the joint venture, the asset brought into an arrangement or subsequently acquired by joint arrangement are the arrangement asset. The parties have no interest in the asset of the arrangement, the obligation for the liabilities. In joint operation, the parties of the arrangement have to share their liabilities, obligation, costs and expenses in a specified proportion. The parties to the arrangement are liable for claim raised by third parties. Obligation for liabilities in joint venture is joint arrangement is liable for the debt and obligation of the arrangement. Parties are liable to the arrangement to extent of first, their respective investment. Second, the obligation to control any unpaid control, or lastly, both. Creditors of the arrangement do not have right of recourse against any party for debt or obligation of the arrangement.
Assalamualaikum. Hi, my name is Hazirah binti Nur Azmi. So, for the question 3A, the question asks for the relationship between Lily Berhad and Barry Berhad before and after the right issue. And FAR610 state that where an investor holds more than half of voting right of an investee, the investor has power. On 1st July 2014, which is before the right issue, when Lily Berhad acquired 75% of 800,000 ordinary shares in Barry Berhad will become a subsidiary to Lily Berhad as Lily Berhad acquired more than half of ordinary shares in Barry Berhad. On 1st May 2017, which is after the right issue, Barry Berhad is still subsidiary to Lily Berhad. After the right issue, the percentage of share of Barry Berhad is now become 58%, which derived from 600,000 divided by 1.04 million. Total share of ordinary share in Barry Berhad now is 1.04 million, which is 800,000 plus 2/5 of 600,000. Barry Berhad is still a subsidiary to Lily Berhad because it holds more than half of ordinary share in Barry Berhad. So, for the question 3B, the question asks for amount of goodwill on acquisition. For calculation of goodwill, it consists of Part A and Part B. So, for the Part A, it consists of the consideration transfer of ordinary share, which is RM 1.8 million, and NCI of 25%, which is 0.4 million. So, the total of Part A is RM 2.2 million. For Part B, it consists of fair value of net asset, which is RM 1.6 million. Goodwill will arise when Part A is more than Part B. Thus, it will derive 0.6 million of goodwill of Barry Berhad. Next, for question 3C, Barry Berhad will get a loss from not retaining same percentage of interest. First, Barry Berhad is still a subsidiary, so it still retain control. The proceed received is RM 120,000 that derived when 240,000 ordinary share times with Fair value of net asset investment of RM850,000 will be deducted. RM850,000 is derived from 17% from 5 million of fair value of net asset very berhad on 30 April 2017. Then, the loss of RM730,000 will be recorded in consolidated statement of profit or loss. For question 3D, Lily Berhad should record the effect of the private placement in consolidated financial statement. After private placement take effect, the computation for gain or loss is: first, cost acquisition of RM3.5 million is deducted from fair value of net asset of RM3.15 million that derived from 36% of 1.25 million ordinary share times with RM7 ringgit. The gain of RM350,000 is recorded in consolidated statement of profit or loss. For question 4, it asks relationship between Aisyah Berhad and Adam Berhad. FAR610 define associate. On 1st October 2017, Adam Berhad is an associate of Aisyah Berhad. When Aisyah Berhad acquired 40% of Adam Berhad ordinary share for RM2.75 million that carry voting right at a general meeting of shareholder of Adam Berhad and has significant influence. On the same date, Aisyah Berhad also acquired 50% of Adam Berhad convertible debenture at par. In the situation, if the debenture are converted into ordinary share, Aisyah Berhad can increase in its interest Adam Berhad by 25%. Thus, total ordinary share that Aisyah Berhad acquired from Adam Berhad is 75%. FAR610. Now, since Aisyah Berhad acquires 75% ordinary share of Adam Berhad is subsidiary of Aisyah Berhad. As none of the debenture have been converted into ordinary share by 31st December 2017, hence, the relationship between Adam Berhad and Aisyah Berhad is an associate since the percent is not more than half, which is Aisyah Berhad acquired 40% of Adam Berhad ordinary share.
The acquisition method involves 4 steps, which is identifying the acquirer, determine the acquisition dates, recognize and measure fair value of net asset, and recognize and measure the goodwill or bargain purchase. Non-controlling interest is recognized at the acquisition date either at fair value of share held by the NCI, which is full goodwill, or equal to proportionate share at the fair value of the net asset of subsidiary, which is partial goodwill.
Two types of impairment goodwill, which is impairment loss of partial goodwill and impairment loss of full goodwill. For full goodwill, the impairment loss need to be portioned with parent's profit and non-controlling interest according to holding interest. Partial goodwill, the impairment loss is written off against the parent's share of profit. For the joint operation, the operation can be structured either through a spread entity or no spread entity is established. In a joint operation, the ventures called joint operators have right to the asset and obligation to the liabilities of the arrangement.
Farhana, if Mercury decide to dispose 50% of his share from Venus, what is the status of relationship between Venus and Mercury?
The Mercury current share in Venus is 60%. If Mercury decide to dispose 50% of his share in Venus, the share now is become 30%. Thus, the relationship between Venus and Mercury now is no longer subsidiary but associate.
Next, if Mercury acquire only 80% of debenture in Venus, is it true the balance of 20% is for NCI? Please give a reason.
No, the balance of 20% not held by Mercury cannot be treated as NCI because it is an actual liability of the group.
Okay, Hazirah, let me ask you, what is private placement?
Alright, private placement is the sale of share to a chosen group of investors in order to raise capital. Share may be offered to the public in a public offer, or alternatively, they may be offered privately to a limited number of qualified persons in a private placement.
Next, what is the meanings of goodwill?
According to FAR610, goodwill is an asset representing the future economic benefit arising from other assets acquired in a business combination that are not individually identified and separately recognized.